We're here at the headquarters of FF Venture Capital with its founder, John Frankel. You come from a non-traditional background into VC. You were at Goldman Sachs for 21 years. Tell us a little about making that transition and what you bring from that experience.
I was at Goldman for a ridiculous period of time. And I remember when I started there, I said that I'd make a mental commitment to 2 years. And 2 years became 3. It became like a rolling 2 years. And so 21 years kind of like crept up on me. And then in the mid-90s, I moved to the sales and trading floor as a salesperson covering hedge funds for US shares in New York. And I got to learn a lot about portfolio management, portfolio balancing, what makes a good idea.
Around 98 or so, you started getting into traditional angel investing.
Late 99, I missed the bubble.
Missed the bubble.
That probably was a good thing.
During that time, 99 to 2008, you make what, 10, 20 investments, something like that?
Made a fair number of investments, a fair number of companies.
Yeah.
What I learned, or what I developed, was a view that your initial investment is just that, it's initial investment. And so strategically, I would concentrate capital into my winners, not into my losers. I would follow on.
And at some point during this progression, you got into the early stage investing, angel investing, et cetera. You're saying to yourself, I want to get into venture capital, I'm going to start a formal fund. When did that happen? How did that happen?
Well, when I left Goldman in 2008, I decided to take 6 months off to do nothing. Having spent so long at one firm, it's very easy for the knee-jerk reaction to be wrong. And I'd spent most of my career saying, what do I want to do when I grow up? And I was 46 then, and kind of like, probably I should start firming that up. So after 5 months, I found myself in a lawyer's office, drafting up documents, and we raised our first fund with outside capital in November 2008, 2 months after Lehman blew up.
So a lot of these guys said, John, we know you for a long time. This early stage stuff is risky, but let's give it a whirl. Is that how it happened?
Yeah, that's how it happened. And I want to pick up on a point there where you say it's risky, because people always say to me, well, this early stage, right? And I hate the moniker super angel, and I hate the moniker of micro VC, but we sit somewhere in there. We're trying to bring traditional institutional quality investing down to the angel size check. So that's where we are. But people say that this space is really risky. I go, yeah, it's really risky. It's but it's got no emerging market risk. It's got no Japan nuclear meltdown risk. It's got no interest rate risk. It's got no commodity risk. It's got no is the euro about to break up risk. It's got no debt risk. Got no muni risk. So yes, it's very risky. What it is, it's pure alpha. And if you put together a basket of pure alpha, you can generate high uncorrelated returns, not just uncorrelated with themselves, but uncorrelated with the rest of your portfolio.
What motivates you as an investor?
Well, it's no longer about putting food on the table. I guess I've always tried to find places where I'm going to be intellectually stimulated what I do. And I tell you, I get a better education doing this than I did when I was at Oxford. I get 500-700 really smart people who are trying to change the world come in and sit down with me for 45 minutes, an hour, and they explain to me how they're going to change the world. And then we get to pick the 1 to 2%, the 5 to 10, the 15 people from them each year that we want to work with and help.
We've talked about social, local, mobile, the transformation that's happening. I've read in some blog posts that you've read that it's actually a great time to be alive. We're lucky to be here at this convergence. What's going to happen in the next 3 or 4 years with all this convergence, in your opinion?
A lot of people love to use the word bubble. It's sort of, it reminds me of, we have 5 kids, and when our kids pick up on a new word, it becomes the word of the week. And I think there's a bubble brewing. But the bubble isn't in early stage valuations, which I think are getting a bid to them. The bubble isn't necessarily in later stage valuations yet. Where I think the bubble will happen will be in the private markets. I think it will happen in the 2, 3, maybe $500 million and above valuations in the private markets, where public market participants say, I want to buy the next LinkedIn, I want to buy the next Google, but I want to buy it before everyone else. They will come in and buy. Look, everyone wants to own 100 shares of Facebook. And there aren't 100 shares of Facebook for everyone to own.
Right.
But it's much easier to buy it in the secondary markets today than it was a year ago.
Yeah.
And it'll be much easier to buy it in a couple of years.
I agree with you. We've got a few years to really make stuff happen here. But do you think that the SEC or somebody's going to kind of crack down on?
Not yet. I think the SEC will encourage it until it goes too far. And that's why I think there's a few years to play. I also think there's a few years because people say LinkedIn's valuation is ridiculous. And then they'll double and triple and they'll go, huh. So I think you need to change what people think are sensible valuations. But I'll tell you what we see, we continue to see an unbelievable number of amazing companies. You know, we start with a process of looking at hundreds of companies and selecting 1 or 2% of them. But the net result is we should be investing in 4 to 12 companies a year. We invested in 12 companies in the last 7 months. And we're not alone. A lot of our compatriots out there have been investing at a faster pace than expected. And you know, they're great companies. They're doing great things.
Let me ask you this. You know, if there's some unbelievable entrepreneurs watching you today, what's the best way to get in touch with FF Venture Capital?
Direct message through Twitter is pretty good. If you don't know me or know anyone who knows me, I know a lot of people, and you know, a warm intro is so much better. In fact, every investment except for one that we've made has come through a warm intro.
John, it's a pleasure talking to you today. Thanks for hosting us. It's great to see you.
Not at all. Thanks for having us. Cheers.